Think about the last time you opened the Social Security website or a retirement calculator. You're staring at the 3 ages like they're buttons that change your whole future. 62. Full retirement age, 70. You hear one person say, take it early. You earned it. Another says, no, delay to 70. Bigger check. And you're stuck doing math that feels weirdly permanent, because it is. You don't just pick a monthly deposit. You're picking the baseline for the rest of your life. For your spouse, too, if you're married. And you're trying to avoid that sick feeling of realizing you claimed wrong and can't rewind. So you run the break-even age. You compare totals. You try to be the responsible one. Here's what most people don't realize. The best claiming age can flip years after you retire. Not because you miscalculated, because a rule you probably aren't modeling yet quietly changes your taxable income later, and turns a calm plan into a surprise tax spike. That familiar claiming age debate? It's missing the piece that usually hits you after you've already locked in your decision. It's called an RMD, a required minimum distribution. That's the IRS rule that forces you to start pulling money out of most tax-deferred retirement accounts, like a traditional 401k or traditional IRA, even if you don't need the cash. And the key word is forced. Under Secure 2.0 rules, RMDs generally begin at age 73 for many retirees, and your first one is due by April 1st of the year after you reach that age. After that, it's every year. Here's the twist. Those withdrawals aren't just moving your money. They create taxable income, the kind that stacks on top of whatever else you have going on. Now combine that with Social Security. Social Security can be taxable depending on your combined income, basically your other income plus half your Social Security. The IRS thresholds are still $25,000 and $34,000 for single filers, and $32,000 and $44,000 for married couples filing jointly. Cross those lines and up to 50%. Then up to 85% of your Social Security can become taxable. So when RMDs hit, they can push you over those thresholds even if you're living the exact same lifestyle. Let me be clear about something. This turns Social Security timing into a tax management decision, not just a longevity bet. And once you see the stacking effect, it goes deeper than you think. Once you understand RMDs, the next thing to see is how retirement income stacks, like plates. Income stacking is simple. Some income fills the bottom of your tax return first, and everything else piles on top. In retirement, you expect control. I'll withdraw what I need. But RMDs remove that control. They're not a choice. They land on your return whether you want the income or not. Now the Social Security trapdoor opens. According to IRS rules, if your combined income goes over $32,000 for married filing jointly, up to 50% of your Social Security can be taxable. Over $44,000, up to 85% can be taxable. That's not your Social Security being taxed twice. It's your other income dragging more of your benefit onto the taxable side. Take a couple like Denise and Ray. They file jointly. Their Social Security is $36,000 a year. In their early retirement years, they're living mostly off a brokerage account and a little cash savings, so their taxable income stays low. Then age 73 shows up. The IRS Uniform Lifetime Table uses a factor of 26.5 at age 73. So if they have $800,000 in traditional accounts at the end of the prior year, their first year RMD is about $30,000, $800,000 divided by 26.5. That single forced withdrawal can shove their combined income across those $32,000 and $44,000 lines, and suddenly a much bigger chunk of the same $36,000 Social Security check becomes taxable. What does that mean for you? It means low tax retirement can be real at 66 and quietly disappear at 73. So the best claiming age depends on what your income stack will look like when RMDs start, and that points to the real opportunity most people miss. The years before those forced withdrawals kick in. Between the day you stop earning a paycheck and the day RMDs start, you often get a weird little window where your taxes can be unusually low. These are your gap years. Your wages drop. Maybe you're not taking Social Security yet. And if you're living off cash or a brokerage account, your taxable income might look small on paper. That sounds nice, but it can also be a trap if it means you're leaving a big pre-tax balance untouched until the IRS forces withdrawals later. Remember, RMDs generally start at age 73 for many retirees. And the first one can be due as late as April 1st of the year after you hit that age. That date matters because it tells you exactly when the forced income era begins. Now compare two timelines. Timeline A. You delay Social Security. You use gap years to pull money out of your traditional IRA, 401k on purpose, or do a Roth conversion, which means moving money from pre-tax to Roth and paying tax now so future withdrawals can be tax-free. You're basically prepaying taxes in controlled, lower income years to shrink the size of future RMDs. Timeline B. You claim Social Security early, but you leave the traditional accounts alone because you don't want to create taxes. Then RMDs hit at 73 and force withdrawals on top of Social Security. Yes, delaying Social Security can increase your monthly benefit. The Social Security Administration says delayed retirement credits are 8% per year for people born in 1943 or later, up to age 70. But here's what most people don't realize. If delaying Social Security causes you to waste low tax gap years, you can end up paying more in total taxes later, even with the bigger check. For you, the practical implication is simple. Don't decide 62 versus FRA vs 70 in a vacuum. Your claiming age is tied to what you do with pre-tax accounts before RMDs. Now let's make this painfully real with a story that looks like a normal retirement until the tax bill jumps. You've seen the mechanism. Now you need to see how it plays out in a real retiree's timeline, because the tax spike doesn't announce itself. It just shows up after you've committed, and it usually hits the people who did everything responsible the whole way. Picture a retiree like Karen. 35 years of steady saving, most of it in a traditional 401k because that's what every HR meeting told you to do. House mostly paid off, no flashy lifestyle. The plan sounds clean. Delay Social Security for the bigger check, live off savings for a few years, and keep taxes low. Then the calendar flips to RMD time. The IRS doesn't care that you don't need the money. If your traditional balance is still big, the math forces a withdrawal. For example, IRS publication 590B shows that at age 75, the uniform lifetime table denominator is 24.6. That means a $600,000 pre-tax balance would create an RMD of about $24,390, $600,000 divided by 24.6. And that's before counting any pension, part-time income, interest, dividends, and yes, Social Security. So Karen finally starts Social Security, but now she's starting it into a stack that's already taller. What does she feel? Confusion, because her spending didn't jump. Her check didn't change, but her taxable income did. And because Social Security taxation is tied to that combined income formula, more of her benefit can get pulled onto the taxable side right when she thought she was done with big tax surprises. What does this mean for you today? It means the decision isn't just which age pays more. It's which age lands in the years when your tax return is still under your control. So what do you actually do with all of this? Without turning retirement into a spreadsheet nightmare, here's exactly what to do. Simple. 1 page. Real numbers. Step 1. Make your retirement income stack list. 3 Social Security estimates, 62, FRA, 70. Any pension, any part-time work you might keep, and your current traditional 401k, IRA balance. Step 2. Sketch your first RMD year. You don't need perfection. Just estimate the account balance you might have at RMD age, then divide by the IRS life expectancy factor for that age. Add that RMD to the other income on your list. Step 3. Circle your gap years. The years after wages drop but before RMDs start. Those years are your lever. Step 4. Pick a lane. If your traditional balances are large compared to what you spend, use gap years to shrink future RMDs with planned withdrawals and/or Roth conversions. Then decide whether claiming Social Security earlier reduces ugly stacking later. If your traditional balances are modest, delaying Social Security may still be great. Just confirm RMDs won't shove you into that more of SS becomes taxable zone. Step 5. Run 2 timelines side by side. Claim earlier versus delay. But include taxes once RMDs hit. If this was useful, you'll want the next video on Roth conversions in the gap years. How to choose an amount that avoids accidentally jumping brackets. Subscribe if you want more of the system mechanics nobody explains, and drop a comment with your age, your planned claiming age, and whether most savings are in traditional accounts.